The Federal Reserve Bank Term Funding Program, a controversial emergency measure that became more controversial as its life went on. Toward the end, it had attracted all sorts of arbitrage from banks that were seeking to profit from the spread, the borrowing rate that they could get from the BTFP, and then just leaving their reserves on with the Fed and getting paid RUR. However, there was always the question about how many banks were actually using the BTFP as legitimate source of funding that maybe they couldn't get in the marketplace. Well, that question is likely to be answered in the months ahead. And as we're asking that question, the Federal Reserve has said they prefer that banks use the discount window. One of the reasons why they're shutting down the BTFP, in addition to the bad press related to the arbitrage, they want everyone to use the discount window. And they're not the only ones. Bank regulators all across the federal government are pushing discount window, discount window, discount window, almost as if they want to take the Fed back to the 1910s in its earliest days. Well, just recently, the banking system sort of said, we don't want to use the discount window. Because even though the Federal Reserve shut down the BTFP as of this past Monday, March 11th, their statistics show that during this past week, which would have been just Monday, March 11th, 3.4 billion in additional loans were made in the BTFP. Now, that couldn't have been the arbitrage because the Fed shut that down back in January, making sure that they were charging a lending rate that equaled IOR. Therefore, there's no arbitrage free money there, which raises the question, who was actually looking to the BTFP at the last minute in order to engage in more lending from the Fed? And it wasn't just the final week. The week before, there was an increase in the BTFP, a smaller one of 548 million, but still, as this thing is being shut down, suddenly there's banks rushing to it. And by the way, the total balance in the Fed's primary credit or discount window as of this latest week was just 2.3 billion. So there was a bigger increase at the BTFP than there is in the total outstanding at the discount window as the Fed is shutting down the BTFP. So Steve Van Meter, help me make sense of this here. The Fed says we're not going to use the BTFP, and then suddenly in the last possible second, a bank or several banks show up and say 3.4 billion more, please.
You know, Jeff, this is setting up a crisis of confidence because the Fed is supposed to be the lender of last resort. And what happened a year ago in March is they weren't the lender of last resort because everyone said there's such a negative stigma of getting money from you. We're going to go everywhere else, even to places what maybe we shouldn't. And those places said, well, we really don't want to lend you, but gosh, given what's going on right now, we have no choice. And this doesn't look good for the Fed at all, because here you have their banks that they regulate going everywhere else for money except them. And now they're trying to clean that up and say, look, we're okay to go borrow from. Forget those decades of things that we said to make you think that this is a bad place. In fact, it should be considered a good thing. If you need money, well, just come to us. There's no negative stigma. But the problem is, as you know, Jeff, there is a massive negative stigma in the marketplace, and the banks do not want to go there. The challenge now is we knew a year ago that these were all one-year loans from the Bank Term Funding Program. We knew they were going to come due. The Fed was betting that somehow, some way, of course, the economy would recover, things would change, and you could just take bad loans and cover them up with new loans for somewhere else. The issue we have now is the banks don't have the money. We know that. They don't want to go to the Fed. And so here we have a problem. The balances or the payments are coming due. What are the banks going to do?
That's a good question, because Federal Reserve Vice Chairman Barr last December 1st, he gave a speech which basically said, discount window. We want everybody to go to discount window. And I know you've mentioned this before in some of your videos too. The Fed has said, we're going to force banks to use the discount window, whether they like it or not, whether they want to use it or not. We're going to make sure that they use it. The quote that I have from Barr is, banks need to be willing to use the discount window in good times and bad. In other words, they should be there all the time. Therefore, there would be no stigma if everyone was using it. So the question I have is that this BTFP use at the last possible minute, is that the banking system saying, yeah, there's still stigma, we don't want to go to the discount window just yet? Or are there other issues beyond that with maybe collateral, because the discount window requires posting collateral that in their experience last year during the banking crisis, Signature Bank, Silicon Valley Bank, and First Republic, they did not have the collateral to go to the discount window, because if they did, well, they wouldn't need to go to the discount window in the first place, just go to repo market. But either way, they didn't have the collateral, which is why they were no longer viable banks. So the question is, this really curious increase in the BTFP at the last possible minute, is that the banking system, in your opinion, Steve, still saying we don't want to go to the discount window, or is there something else there?
Yeah, Jeff, I think it's saying they don't want to go to the discount window. In fact, I think the banks are still hemorrhaging. I think they've got it stabilized. And I'm going to say that in a nice way, to say they're still in the hospital. They still got things plugged into them and connected to them. But for the moment, they're breathing, and everyone says, well, it can't get any worse. But now they know these payments are due. There's nothing about the banks that have gotten better. It's not like lending has increased, where we've seen them create more revenue, more deposits. In fact, we're seeing commercial industrial lending contract. That's not a good sign here. So the challenge is for the banks is, where do you get the money to pay these loans? Well, if you don't want to go to the discount window because either you don't have the collateral or you don't want the stigma, you go to the one last place you can get it, and you squeeze every last drop out of it and hope that maybe something changes. That's the question here that's going to happen, is when it doesn't work. And as you mentioned in the intro of your show, what happens over the next 3 months is going to determine a lot, because maybe the banks can fake it for a few weeks or maybe a month or so. Then the only other issue is, if that doesn't work, this has to set up a case where the Fed is forced to cut when they don't want to. Only reason is to take some of these upside down assets the banks have so they can go out and sell them in the market and raise cash. That may be the only answer, Jeff. And a lot of people don't believe the Fed could get back to zero, but that may be the only way out for the banks.
Well, that's true too, because one of the government institution that actually is closer to the lender of last resort than the Federal Reserve is the Federal Home Loan Banks. They were that way in 2008. In fact, in 2007, banks all across the United States went to their FHLB and got advances. Now, the FHLB advances aren't really meant to be a last resort liquidity. They're supposed to help banks put together mortgages and to foster more home ownership. That's their original mission. However, during the last 16 years since then, the FHLBs have become closer to the lender of last resort that the Federal Reserve is supposed to be, and its discount window is supposed to be. But the FHLB is now saying, we don't want to do this anymore. In fact, they put out a report late last year, called Focusing on the Future. And what they said was, FHLBank members use advances to support business operations, specific liquidity needs, which allow them to better serve their communities. However, as has been made clear by a number of market events since 2008, a number of market events, not just one or two, the role of the FHLB banks in providing secured advances must be distinguished from the Federal Reserve's financing facilities, which are set up to provide emergency financing for troubled financial institutions confronted with immediate liquidity challenges. The FHLBank system does not have the functional capacity to serve as a lender of last resort for troubled members that could have significant borrowing needs over a short period of time. When there's a question, what happened last year? Because more than the BTFP, more than the Fed's discount window, banks went to the FHLB and got advances. And the FHLB is now saying, we don't want to give you these advances in emergency situations. So the FHLB banks are taking away an important and really a significant source and a significant outlet of emergency funding from the banking system as all of this is coming down, which is kind of, it's odd how much the Fed has been putting this emphasis on the discount window, which seems like there has to be something else behind it.
Yeah, that's what's interesting, Jeff. It's like the Fed's getting some pressure. Maybe it's just backdoor meetings with Congress. We don't know, to say, look, you need to get a hold of your own institutions that you regulate. When they have problems, they go to everyone but you. And that problem, of course, as you noted, stems from the fact that the Fed says, if you're going to the Fed, if our discount window, it's because things are really bad. And boy, if you go there, it's not just a slap on the hand at all in this case. Now we have to change the tune. that, hey, you should be going to us. Well, like you said, Jeff, in good times, hey, you need a little bit of money? No problem. Just give us some collateral. And that way it becomes innocuous to the investing public. Oh, the bank's just going to the discount window. Well, that's where banks go. So why would it be a big issue? There's still some stigma there that we're going to find out that the public doesn't like. Now, how the Fed's going to handle that? Well, they're simple. Well, we'll just close all the other doors. We'll make calls to the Federal Home Loan Bank, and everyone else that gives the banks money said, stop doing this. Change your policies. Don't do it. Send them our way. What will the banks do in this case? That is a mystery here that I don't think we have an answer to. But the problem is, I think we're going to find an answer, but not in the way we'd like to find one.
Yeah, there's a level of uncertainty and a kind of uncertainty that is uncomfortable to say the least. Because as you're saying, Steve, the discount window balance has been basically flat. It hasn't really moved anywhere. So it's not like as the banking system has been prodded and poked repeatedly by regulators, go to the discount window, go to the discount window. They're saying, no, we're not going to the discount window. And so as far as the banks seem to be concerned, they're not taking this invitation. And that includes any of the good banks that you would gotta believe. Like in 2007, the Federal Reserve has all sorts of informal conversations with the quote unquote good banks. In 2007, one of the first things the Fed did when the crisis erupted, it got on the phone with Deutsche Bank and Citigroup and Bank of America and said, hey, go borrow from the discount window so that you show everybody that, hey, this is fine. And they got these banks to borrow a couple $100 million each. It wasn't much, but they did it. In the first stage of the crisis, they had all these big banks borrow from the discount window, which didn't really help at all, but at least they did that. And you have to wonder, are those conversations being had now? Because the Fed continues to push the discount window, and it doesn't, if the conversations are being had, it doesn't seem like it's bearing any fruit because nobody's using the thing. And as you're saying, Steve, it's coming to the point where we're getting to the collision where 79 billion in BTFP loans have to be repaid in the next 4 weeks. The FHLBs aren't shutting down the advances, but it's clear they're frowning on using them for anything more than expanding your mortgage book, going back to the original mission of the FHLB banks. So, yeah, as everybody's heard in the discount window, the banks keep saying we don't want to go to the discount window. There is potential for a little bit more than uncertainty.
Well, Jeff, and of course, it has to be uncertain here because, as we've talked about on your show before, if indeed things were getting better for the banks, what would they be doing? Is paying back some of these loans. Now, granted, you could make the case where, okay, they got in an arbitrage situation, so why would you pay that back? But they should be paying back these loans, and in a big way, because they wanted to tell their depositors, hey, look, you know what? Things were not good back in March last year. We screwed up. We made some bad decisions. We're sorry. But look, we learned from our mistakes. We're actually coming back stronger than ever. You can bring your deposits back. You can trust us. But what we continue to see is just the opposite of that, is they continuously need more and more money to the point where the Fed's just kind of like standing out there with flags saying, come here to the discount window and borrow from us. The problem that nobody seems to be really addressing, Jeff, is why aren't the banks paying this back? Because if they're not paying it back, then this no landing or soft landing scenario that we're going to hear next week from Fed Chair Jerome Powell champion again, just like he did on 60 Minutes, saying that we've stuck this landing, we nailed it, we did it, is not true at all. And that's what's dangerous here, what I'm so concerned about.
Yeah, there's that economic sort of background element to all this uncertainty too, because yes, while the narrative in the mainstream is that the US economy is robust and resilient, recent statistics don't seem to agree with that at all. Even in the latest payroll report, as we've covered ad nauseum here, where the establishment survey looked good in the latest month, of course, it was revised heavily downward the previous months. And then the household survey sent some substantial recession signals. We got more data this week. Retail sales in the United States, again, more downward revisions to previous estimates. And then a lackluster bounce back in February, suggesting that consumer spending may just have hit that wall that everybody's been waiting for. And now that the economy looks increasingly shaky in some of these real important hard data statistics, not just in the PMIs, although the PMIs don't look good either, maybe that's part of this too, because banks have to, you're sitting back as a bank thinking, I got to lend into this real economy. I don't care what GDP says. I don't care what Jay Powell says. I got to look at these borrowers and the shape of borrowers. I mean, the Dollar Tree and a Family Dollar and Dollar General, the major dollar stores said they just this week, our customers can't afford to shop at our dollar stores. So the banks are not going to be like, yeah, let's go out and make a lot of loans. And it also puts them, as you're saying, Steve, on the spot, because that also considers is a major consideration in their liquidity management strategies as well. So maybe they're just sticking at the BTFP because it's the best or the least worst option. Let's put it that way. Least worst option right now. And that as that rolls off and the BTFP gets shut down, banks have to really do take a hard look at the discount window, because there really isn't a whole lot of options, which is the real big point here.
Yeah, Jeff, I think banks are going to be forced there. Under what terms yet? We don't know, because we don't know at what point where the banks are going to be screaming so loud that that's their only option. But we can look at the credit card data. We can see that delinquencies and defaults are starting to rise there. Banks are noting that. And just today, I saw some data that says U.S. foreclosures are up 8% over a year ago. So you start to think about, from the bank's perspective here, if the economy was indeed healing, if we did stick this soft landing or no landing or whatever landing you want to call it, we should be seeing the opposite trend. We should start to say, hey, you know what? These numbers were rising of delinquencies, foreclosures, but now they're trending down. And yeah, okay, maybe the banks need some cash to buffer, maybe for the next year or so through this until everything normalizes. But we're seeing the data go in the wrong direction. And with continued claims staying, up around 1.8 million, which historically, as you know, Jeff, is actually low, but not low when you're coming off a very low level of claims. It suggests that longer these people are on unemployment, the less money they have to make payments on their debt. That becomes a challenge for the banks. And I think that's what we're hearing here. The ultimate question is, how does this all play out? Well, we'll find out in the next 3 months, as you said.
Yeah, it's one of, we continue to move in the same direction, however slowly, where it's no longer just risks to the U.S. economy, because the banks have to lend into this real system. They have to look for these borrowers and say, they don't look like they have enough income prospects to make it worth doing so. And at the same time, now they have to worry about their liquidity profile and their management. It's a pretty bad mix here. It's not conducive. I mean, it would be one thing if the soft landing was actually unfolding, and the banking system would be corroborating that within their activities, when they're saying risks everywhere, risks in our loan portfolios, risks on the liability side with funding. We don't see the same market funding that we got, or at least that we would expect in this type of environment. It really is, as you said, Steve, it really is a pretty toxic mix. So we'll see how this works out moving forward. Looking ahead, looking much farther ahead at more optimistic monetary stuff, the crypto revolution, the real one. I just had a really good conversation with Andy Bromberg about just that, and that's the video linked below. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.